Good evening, everyone. Welcome to Admiral Markets webinar. This topic is understanding the difference between trading and analysis, but also not only the difference, but understanding the key parts of both and how you can combine them. So we'll be discussing that. Of course, my name is Chris, but also Nenad is here with us. These are Twitter handles in case you are following Twitter at Admiral Markets and our names here at Tarantula FX. So first of all, some disclaimers here. The first one explaining the fact that the webinar is shown to a global audience but may not be suitable for everyone. Please seek the advice of independent financial. Please, first of all, visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity before watching this video and live recording. And regarding the seeking the advice of a financial advisor, that is regarding the risk disclaimer. Trading for exchange and global financial markets is considered higher risk. Please seek the advice of an independent financial advisor. By continuing watching this webinar, you agree with this disclaimer, plus you are aware of the risk involved when trading. This webinar is for informational and educational purposes only. All right, there we are with our pictures, and together, Nenad and I were making and building this course called Zero to Hero. And that has been completed. It has been, for some of you, already viewed in its entirety, 21 days throughout October, but I think it's still available. It is for free, and as far as I know, it's still on the website at admiralmarkets.com. If it isn't in the future, if you're looking at the recording, then maybe just send a message through customer service, and I think there could be still an option to join in the future as well. But best is to ask. All right, so analysis and trading. We talk about it quite often in the trading rooms that we have on Tuesday, Wednesday, for instance, where we take a look at live market environment in the morning. And often I mention the triangle of analysis. The triangle, as you might know, is consisting of trend and impulse, so the direction, where is price heading to. It consists of support and resistance, where might price stop and turn or continue, and patterns that indicate the market psychology and show kind of what direction the price might continue or reverse. It kind of gives us some hidden information there. Reversal patterns or continuation patterns are part of that, basically, analysis. So with these three things, I make a judgment about the market structure, and I understand then more about what price is most likely going to do, which kind of direction this is going to head towards, where it could be bouncing spots. So these are the three main things that I use to understand that. So for each of these three things, I use different tools and indicators. I myself use a moving average or moving averages in most cases. I use, for instance, chart patterns, and for support or resistance, you'll see me use pivot points, fractals, or fibs. Right? There are a lot of options, but these are the ones that I use often. Now, if you would use, for instance, Ichimoku for trends and impulse, I can totally imagine that's a perfectly fine way of looking at it. It's not the one I use. Doesn't mean it's not valid. Everyone can fill in these three things with their own preferences in a way. My main point here, my core kind of idea is that I think that traders can choose whatever they think is best, whatever fits with them as well, and then just stick to that, right? So that process might take some time to find out what you like the most. I already have my preferences, obviously, and that's how I then analyze the market. Now with trading, there is a bit of a different kind of gear. When analyzing, I kind of look at these three things and I derive if I'm interested, in what direction I'm interested, and then I move on to trading decisions. Then I want to know, if I am interested, where I want to trade it. So what I then look at is confluence. I try to find key decision zones where price has to make a decision. What I above all want to avoid is trading it in areas where there's low kind of probability either way, or it's a coin flip either way. Coin flips could still be okay as long as the reward to risk is there, but often if price is in the middle of a triangle, it's a coin flip in a way. There's no clear direction which one would be a better trade. Plus the reward to risk is not there either. So I want price to be or reach clear decision zones where price has to kind of, it's forced to show and choose a direction and then I follow it. All right, I want to be basically, when dancing, I want to be the one that is following the leader of the dance. All right, so the market is the one that's leading the dance. I will be following it. If I'm anticipating a trade too soon, or if I'm chasing a trade too late, all right, then often price has already moved away from the decision zone, and it's more or less emotions that are pushing me to take a trade at a worse spot. All right, it's regret. It's some kind of emotional trigger that is snapping and said, I wish I was in the trade. Look how good it would have been, and still enter late or enter too early. And all along, it would have been better to wait for price to reach the decision zone. And if it's already gone, then to look for new decision zones. Then I look for triggers at those decision zones, and then I take entries. I take the actual entry, right? And the stop loss and the target. So this is the triangle of trading, and these are two separate things. So regarding direction, it's basically a mixture of trend, momentum, range, understanding what state or what kind of phase price is in, understanding that the support or resistance, how it basically impacts the trend. There could be a huge confluence of resistance that could stop the trend, especially if momentum is also waiting and fading and running out of steam. That specifically is another factor when momentum is dying out and there's a strong confluence of support or resistance. Well, in that case, the trend might be in serious problems. When you take those two things into account, plus you add perhaps a divergence pattern. You add, for instance, an impulse pattern on a lower time frame, counter trend impulse already. The things are starting to add up, and before you know it, you're building a decent case of a potential reversal, right? And that could be the same for with the trend setup, right? Let's say that the trend is showing no divergence, momentum is still strong, and there's a support level at the 50 fib where price has already is about to pull back to, and we see a reversal chart pattern at that 50 fib. Got a strong case for trend continuation. The things I use for the trading aspects, I've talked about that a lot on Wednesday. For triggers, I use time patterns and candlestick patterns, for instance. So I'm looking here for confirmation of price in that decision zone, basically, right? So the decision zone, there are various things. I use Keltner, I use pivot points, trend lines. That's where I'm waiting for price to get back to. And then the trigger would be typically is a candlestick pattern for me, or time pattern, or a fib as well, Fibonacci pattern. So these are my main things of analyzing the trading and the analysis. For instance, here is a live example of a trade where I took a time pattern trade here, a hook back. This looked like a weakness hook back. This looked like the end of the momentum to the downside from my perspective. One of the things that I saw was 5 waves, for instance. Now, not everyone is fans of waves. That's fine. But for me, that was a factor. I had time factor here as well. Plenty of candles not breaking this low. I saw candlestick patterns as well, and I was a bit late. That was just purely because I actually just, when I was analyzing price, but then during monitoring, I missed a few candles, and before I knew it, price was there. That was just purely based on fact that I missed it, right? That has nothing to do that it was on purpose. But in any case, I took it there, as you can see. So it was based on the hook back and the fib pattern, the time pattern, candlestick pattern is probably here as well. And we got the upside. Now, the trade management point of view, I use the same analysis. Basically, I kept the analysis going. And what I typically do with trade management is give space, then become more demanding, give space, then become more demanding as time goes on, and trying to reduce risk, move the stop loss to break even, then become again more spacious because then the trade is maybe even in profit, or at least the risk is less. That's fine. So I'm going to let the trade run. I want to let my winner run. But once the winner runs, I want to become more demanding, and I use a tighter trail again, or I take profit. So I don't use the same kind of trade management style at every single point. I vary it, and I keep analyzing basically continuously. Of course, not always necessarily. As I said, I give space at the beginning of the trade, so I'm not every single minute using that new info. Of course, only at the times that I think it's appropriate. So I use this model basically to find a balance in how much time I give without basically holding on too long. I don't want to hold on too long because then you, as a trader, tend to become or go into a hope phase. Oh, I hope it will still turn. That often doesn't end up well. At the beginning of the trade, you don't want to exit too soon either. At the beginning of the trade, you're not hoping. You analyzed, right? I analyzed it. Trade setup made sense. So I got to give it some time. But if it takes too long, yeah, then there should be a moment that, I'm going to be more demanding. For me, 5 to 6 candles, again, is at the minimum I want to wait. So in this case, I entered. Good news for me because price went immediately my way. So that's excellent, right? I got a small little triangle here. I could move it to break even at this point. That's a perfect example. That's a good example. I didn't have much worry in this case. Now, some of us have trouble with being in profit because then we're like, oh, what if it reverses and we'll be grabbing profit? That can sometimes be okay, but if you do it too often too soon, you're going to eat up profitability too much. Remember, the goal is always let the winner run, cut the losses short. What we tend to do is the exact opposite. My trade management module is intended and specifically geared towards living up to the words, let the winners run, cut the losses short. This is exactly what the trade management style is focused on. And I've not seen many, I've heard this expression a lot. I've never seen actual practical examples how you're supposed to implement those words. From my point of view, this kind of trade management style does cater to that, slogan. So I myself was not worried about the zigzag. I knew that after a 5-wave up, after momentum up, there was a good chance of a larger ABC zigzag. So for me, this downside was corrective, especially when I saw an ABC like this, especially when I saw a 3-wave move like this. I was not worried. I had it to break even anyhow, so everything was good to go, and I was not risking anything. I felt confident that this was going to be a bigger zigzag, so I just left it be. And indeed, sooner or later, we got the turn, price moved up, then we got a corrective flag. Still wasn't worried because of the chart pattern that was indicating a bull flag. We got a break of the bull flag, and then we got about triple divergence here, and here I exited indeed, because to me, the start of the downside started with quite a lot of momentum. It was a Friday, so I didn't want to hang in through the weekend. So those are a couple of reasons why eventually at that point I exited. All right, so let's dive into some live charts. Let me see if there's some questions in the meantime, by any chance. No, not yet. Okay, perfect. So let's take a look at some live charts. So basically, let's give an example of earlier this week. The euro dollar at this point was showing some upside. The 4-hour trend at that point was still down, but the impulse was certainly up. And basically at this point I was in the live room Tuesday. Here I was saying look for bounces at fibs on Monday, by the way, right? Look for bounces at one of these three fibs. No, I used a different fib. I used this fib, sorry. So it was the lowest fib of those three. We got the bounce. Then Tuesday morning, live trading room, I said look for the breakout above this resistance because that could be the continuation of this bullish momentum. We are now looking at the hourly chart on euro dollar. So now one thing, of course, is the analysis. Let's just dive very quickly into that. From my perspective, this was momentum, and I was looking for an ABC zigzag up. I was also, from a higher time frame perspective, excuse me, I need to get rid of this fib. Otherwise, it will not be all too visible. There we go. All right, on a higher time frame perspective, so that was what I expected here. Good daily candles, by the way. I expected an ABC zigzag based on that. But on higher time frames, like the weekly, for instance, let me get rid of this magenta line, sorry for that. I'm still working with these charts, as you can see. So on a high time frame, I was looking for triangle continuation. All right, now in this case, also I have to add that, for instance, a political event next week like the US elections did play a role as well. I did not necessarily expect a full-fledged breakout here right before such a big event. That was a factor that plays a role, not very often, obviously, that's not something that typically happens, simply because elections are only once in 4 years, right? So this is a bit of an exception. But from that point of view, the psychology of the market, I don't think was ready for a breakout. I, therefore, was more inclined to look at a triangle, although I did say that if it fell a lot with a lot of momentum, then, of course, things would change. Now, it didn't fall enough momentum. Yes, there was a bit of a push, but didn't push through 107.50, what I wanted to see. And that was another reason. So there was a bigger triangle taking place. This looked corrective pretty much too, so I'm looking for an ABC up. To finish the triangle, that would be the fifth part of the triangle, or the wave E for those that like waves. And then I do expect a downtrend to continue. So these are some things that I was looking at from an analytical point of view. You know, you had basically a pattern on a higher time frame. You had on the low time frame momentum. You had on the low time frame, you had pattern as well. This was a triangle. Support or resistance? Yes, there was a resistance at 110. That was one of the reasons why I said I wouldn't trade this particular candle here, although it was showing a good breakout, and that often enough would be the candle that I would be looking for a long. But not in this case because of resistance. So here, basically reviewing the analysis I was doing on the euro dollar, looking at those three things, pre-fact, now post-fact, but at that time pre-fact. All right, so then the second step, of course, was looking for basically trading. Right, one thing is analyzing it and basically understanding that, in my opinion, it was bullish after the break, and that turned out fine. The analysis, we can say, from my perspective, was correct. We got the upside after the break. The analysis exactly did what we expected. Perfect, right? Now the second question is how to make pips from that. That's a total different ball game again. So let's talk a bit about that. So at that point, I was saying my trading plan was to wait for a break of 110. So I'm a bit lost now. Let's see, sorry. Let me put a line there to right here. Okay, good. There we go. Now go to forward. All right, so waiting for break for 110, looking for a hook back to 110, and then taking a bounce. So here we have it. All right, this is price pushing to 110, reaching 110, making a smaller consolidation here. I already said on Wednesday that more advanced, riskier traders perhaps would have been taking the break of 110 here. There was a small pattern there, but that was not really the one I was talking about because I was waiting for the break of 110. Here, price didn't break 110. It was stopping at 110. So that, was not the one I was really looking for. But, more, as I said, more aggressive maybe would have been possible. But here we get the 110. Here we get the hook back to 110. And that's basically the hook back I'm looking for. Now, ways to enter. One of my favorite ways is looking for candlestick patterns and time factor patterns. Now, on a 5-minute chart, time factor pattern, 5 candles not breaking this low. There's a strong chance that this correction is over. So 1, 2, 3, somewhere in here, right? That's where I took the long and looking for a stop loss. I sometimes use 5-minute fractals, but it can be a bit risky. 50-minute fractals sometimes have the advantage. So, here, for instance, 109, it depends, 109.90 or otherwise simply just below 110, sorry, not 110, 110 are all options, all right? Generally speaking, 50-minute fractal is pretty good, or 1-hour candles, lows, or even a 5-minute fractal sometimes works, but sometimes 5-minute fractals do get broken, as you can imagine. So, all right. So in this case, though, 5 candles here, this fractal held, but I think the 110 would have been probably better. I don't think there's any reason to put it at 110.05, to be honest. And yeah, the upside happened. Candlestick patterns, that was a time factor pattern. Candlestick patterns, well, there was a doji here, and there was a bullish candle there. Not clear patterns, but I think bullish candles indicating the bounce. So this was something, talked about it pre-fact. That was the trading plan idea. This was the intraday swing trade that occurred on the euro dollar. This is basically, it's basically translating that analysis into a concrete plan, into understanding where the confluence is, where the decision zone is, and then waiting for the trigger at the decision zone. All of that happened in this spot. All right, so let's talk about maybe another example. Let me think here. Dollar yen zigzag, right? We had here we're indicating that this could be a basically reversal environment, a zigzag. That was the analysis. That there could be either a triangle or a bearish zigzag steeper momentum correction. Those are the two options. So that was the analysis. Now the conclusion after that for me was either not traded because of its counter trend, right? That was the main conclusion for me. So that's perfectly fine too. If, often enough, it's very perfect strategy just to skip a trade and do the analysis and figure out, okay, this is not an instrument for me today. I'll skip it, set it aside, look at something else, look what other things are doing, find maybe more suitable setup. Happens to me often that I rather just wait for one pair to align, that have a trend on the higher time frame, align with the trend on the lower time frame, and wait for that to happen. This didn't have that, so it's fine to set it aside. Depends all on our own, how aggressive we want to trade, how many opportunities to trade we're looking for, our character, trading personality, trading psychology. Those things become very important. If we're looking for more opportunities, then we probably would not skip this one, and we would be we would analyze it and say there's a good chance of a correction, would be more aggressively looking for that entry to the downside. And if it doesn't go and you get the triangle, right, be trying to manage that trade and not lose on it. If we do get the correction, trying to hang in there. So assuming that we're more like looking at an aggressive type of trader, then one of those ways, once again, would have been, from my perspective, how I do it, the analysis was bearish. So, for instance, here, I was saying that this is not a good place to buy because it's hitting resistance. So 5 to 6 candles not breaking this high, for instance, on the 15 or 5-minute chart, giving the opportunity to look for such a turn. Or on the hourly chart, maybe, let's see. 5 to 6 candles is a bit late in this case. 2 bearish candles already is a bit of an indication already that it's looking at weakness. But maybe we can find, it doesn't matter which time frames. Sometimes you can see that on the 4-hour chart, you can see a good candlestick pattern. And not in this case, as you can see, you have a doji here. Nothing special on the 4 hours. So you don't always have the perfect time factor pattern. You don't always have the perfect candlestick pattern. That's why I use multiple things, because sometimes one of the two doesn't play out. In this case, candlestick patterns are not really abundant in that. But the time factor pattern was pretty clear, I think. All right. So that's my way of doing, looking for triggers. I appreciate the candlestick patterns, the time factor patterns, and the fibs. But here too, same is valid. Others might be using, and I use Kelton, but Kelton I use differently. Kelton I use more for, I use that more as a decision zone, not really to trade. I don't take it for like a trigger. So that's my way of doing it. What I wanted to say just to finish is that, but other traders do it differently. They use different entry methods. But it's important to find something that suits you, that you find comfortable with actually entering, right? And it could be various things. It could be it could be just levels. There are traders out there that are great in picking levels, entering just based on levels. Bennett talks about it in his recaps. He has levels right there, exactly what he's looking for, the stop loss, take profit, and that's perfect. I sometimes do that too, but I'm more prone, as you might know, towards the market entries. I use pendings really when there's a lot of confidence, when I'm extra confident. When I am, let's say, average confident, I rather look for those candlestick patterns. So that's what's happening here with my view. Any questions at this point? Regarding the candles, basically the candle count, stuff like that, it's all about basically momentum. And as long as candles keep pushing higher highs and higher lows, lower lows and lower highs, there is momentum. As soon as 5 candles don't do that, momentum is waning, it's dying. So that's why those 5 to 6 candles is so important, and that's why that time factor pattern is used for me as a trigger. So perhaps I can dive into that just a bit more. I still have some time. Oh no, actually, almost running out. And then it's going to continue with his part very soon. But let me just explain maybe a tad more on that. So for instance, the pound yen. All right. So here you can see 5 to 6 candles not breaking this low. 1, 2, 3, 4, 5. That's here. All right. From my perspective, at this moment, this downside is over. Right. That, especially with divergence here. So there's a good chance there's at this moment the bearish swing high, swing low is completed. It's either going to be a bullish correction or there's going to be a bullish momentum. Now, if there's a bullish correction and it goes sideways like that, I still have plenty of time to exit, and the bear flag would indicate that there's a good chance of continuation. However, if it's the opposite, that's great, because if I'm in that long, then momentum is on my side. So that's where this is basically, I don't know I don't want to say that this is the best swing trade example, but just based on, let me say it this way. On a 4-hour chart, let's say that on a 4-hour chart, I was looking for a massive bounce here at this time frame. All right, that was the analysis. And on the hourly chart, we see this. Well, then that's a great point of confluence, and this is the trigger. So I use the time. My point is that I use this time factor, the candlestick patterns, the fib patterns. I don't just use it everywhere and anywhere. I use it at spots where the analysis leads me to say this is a high probability zone. I don't, stress yet again, don't use it anywhere and everywhere. All right, because then it's just too, you don't have that edge. You need to wait for a zone where that edge is visible. So 5 to 6 candles, so that could be one way, but if you want to, another way could be to zoom in, right, to lower time frames and look, for instance, for even a different way of entering. At this point, there was the 1 hour candle, the 1 hour time frame confirmed the bounce. But if we're looking for a 5-minute bounce here, we're seeing a bit of a bull flag. Then 1, 2, 3, 4, 5 candles right there. Let me show you. This was the confirmation of the hourly chart. On the 5-minute chart, we have 1, 2, 3, 4, 5, fifth candle right here. So, that could have been the entry on the 5-minute chart, for instance. So this is how you can play around with multiple time frames as well. All right, so that was my part. I'm going to hand it over now to Nennet. He's going to dive into his views on analysis and trading.
Thanks, Chris. Excellent presentation. And yeah, I will continue now with my part. So I will, at the first point, I will stress out some difference between traders and analysts, and actually what is the main difference between traders and analysts. And the first thing that you might notice is, I mean, both of us are also traders, so we're not just an analyst, out-of-the-mill analyst. You can see a lot of articles, analysis across the internet, so a lot of people simply can do that and they still think that they help people. But unfortunately, guys, for both trading and analysis, you really need to have a vast knowledge of markets. I mean, for the analyst, it's more important that educational part of price action. For trader, some other things are important. But the best thing is if you can unite it as a whole. First is to say that a trader is a person who executes trades for a bank, trading firm, hedge fund, or his own personal account. That is a trader. So trader is different from the analyst. It's completely different. But the analysts, they perform research and consulting roles for portfolio managers. So analysts don't trade, guys. That's the difference. Analysts simply perform research and consult with portfolio managers, and they research for traders, and traders execute trades. It might be similar to you, but it's actually a lot different. Because the analyst will usually try to simplify things, right? I mean, I will show you how typical analyst chart might look like. And you will find all sorts of examples across the internet. So you will see what I'm talking about. And trading is, again, something completely different. Traders trade what they see. Traders are prone to money management errors. Okay? That's very important to stress out. Traders are very prone to money management errors, and they simply cannot control their emotions. Traders who control their emotions are full-fledged traders. But most of the traders, they might be good traders and can see where the price will go and trade it, but those money management errors can make their accounts look bad, even though they're good. So attention span for a trader can be very short. That's also one of the things that that signify the difference between traders and analysts. Because traders usually wake up early in the morning, right? They open their system and they trade at the very first signal they see. Usually, I'm talking like, I know because I have a lot of also friends who trade and people who I know from various forums. So the attention span of trader is very, very short. Believe me. Traders would usually jump at the very first opportunity market gives them. Analysts don't do that. Analysts simply, they don't trade. Their role is to provide you with the analysis and nothing else. They don't even tell you, usually, where the price might react. They simply say, okay, we see that, let's say, US elections is very close, and we think that because of that, dollar would probably, the risk, making all basket of dollar going up. And they give you levels. I mean, that's a typical analysis, right? The point of the analysis, in my opinion, is different. I will talk about it in the next chapter. Trading firms and companies, they use a separate analyst and risk manager. So usually in trading company, trading firm, you will see a trader or a couple of traders. It's called trading team. You will see a risk team, risk management, and a separate analyst. Analysts provide trading team with his own views. Then trading firms, trading team need to use the analyst opinion and risk management opinion about potential trades. That's very important for you guys to understand. And then trading team execute orders. Trading team might be in a completely opposite view than a trader. That's also important to know. But it doesn't matter because trading team will ultimately take responsibilities for their trades. So risk management provides each morning trading team with their risk calculation, saying, okay, you can use 2% of risk, you can use 3%, whatever the risk is, according to the rules of the company. Try to, for example, try to keep the risk as high as 5% per week. Then traders need to find those trades that can actually fit into those 5%. But then analysts give opinions to traders which pairs are best to trade. And according to that, trades are executed. But have in mind, guys, that it's traders who will ultimately call for an action. They press sell and buy buttons. But in companies, traders simply do not think about risk. It's not their job to think about risk. That is the difference between retail trader and institutional trader. Because a retail trader, if he trades with his own account, obviously he needs to think about risk. Right, guys? You think about your own risk when you trade your accounts. In company, other people do it for you. You just need to find those levels where to press sell and buy buttons. And you use the risk that risk department, risk team preemptively gave to you. Have in mind that traders are very susceptible to emotions. Because of that, analyst's job is a little bit, I mean not a little bit, but it's much easier in that part. Analysts don't think about risk. And traders usually trade some predefined number of markets, because some traders simply don't feel comfortable to trade CAD yen or pound New Zealand. They prefer to stick to major pairs. Or I know some traders, they call themselves professional euro dollar or professional pound dollar traders. That's stupid, guys. That's nonsense. There is no professional euro dollar or pound dollar trader. I mean, I have never heard of that term in this business. That's simply nonsense. Traders should trade different markets. There is no professional euro dollar trader. It's not true. A good trader can trade 10 different markets or 15 different markets. And now, pay attention to what I'm saying. A good trader can also lose. Not because he is a bad trader, but simply because of these emotions, guys. When you have risk department and risk compliance behind you, you will make money much easier than when you trade with your own account. Because you, simply said, you are watched. You cannot use emotions. If you use emotions, you will be fired. And you have the conscience about it. You will be fired if you use emotions in a trading firm. But if you do that with your own account, guys, you know what happens. Simply said, you will burn your account if you let your emotions overwhelm you. That's, guys, the difference. Okay, that's the difference between institutional trader and retail trader. And that can be a big difference. Analyst simply does a research only. That's the job of the analyst. Doing a research. Okay, it's nothing less, nothing more than that. And usually most of the analysts have a very limited money management knowledge. Simply said, the knowledge is very, very limited, guys. Okay? They are not concerned with risk. They don't care about the risk because it's not their job to think about it. But the trait of the good analyst is quality price action analysis. Now I'm talking from a perspective of analyst who works for a company, for a firm, trading firm. Good analyst needs to observe complete price action of, let's say, 20 different pairs. And he then cherry picks different markets and provides traders with his or her own opinion. The quality of price action view should be very, very high, because usually it's connected directly to trading team that will search for tradable opportunities based on the analysis of a good analyst. Good analysts need to know all markets, not just euro dollar, pound dollar. They need to know about crosses, euro CAD, cross currency pairs, CAD yen, CAD Swissy, Mexican peso dollar, dollar ruble, right? So a lot of different markets. Being stuck in a single currency might really give you bad trades, because we witnessed that euro dollar was ranging 2 or 3 months. Nothing was happening. Now we see some movement, but this movement of euro dollar is simply because of their risking before US elections. And it's like uncertainty. We will provide you with, of course, a complete coverage of which pairs to trade and how to trade US elections. On Monday, it will be like session recap, but instead of standard session recap, we will do a specific setup for US elections. And have in mind also that quality analysts need to know both technical and fundamental analysis. Good analysis is not just watching technical levels. Because some people would say probably today, let's see where we can sell euro dollar now, right? I mean, we tried to sell it on session recap, but the price went higher because there were some news that Trump was leading the elections, and it caused automatic risk off. They're risking in the market, so dollar fell, euro jumped. I mean, that's fundamental view. And that is because I gave you today's analysis of euro dollar saying that you can go long, and if you went long at POC zone, slightly above POC zone, you would have made 30 pips. That is not bad. I mean, euro dollar now at this point today was long. Tomorrow is NFP, so we still need to see what will happen, but definitely we need to pay attention. Okay, now that's about technical and fundamental lines. Now, guys, I will show you the example of difference, as I said, between technical and fundamental, and trader and analyst. So this is how a typical chart of an analyst looks like. I mean, most of these charts can be seen over the internet. They put some random indicators just to, but I really don't understand. I read a little bit of those analytical pieces across the internet, and I mean, I cannot understand most of those things. It's very simple and it doesn't tell me anything. They usually have two moving averages, 200 moving average, or I don't know, 100 SMA, RSI, and it looks like this. Euro dollar spiked today because the price was moving towards moving averages. Then we saw that the first moving average was broken. There is scope for the second moving average, this moving average. I mean, the point of this blah blah is just most of the analysts will give you post-fact analysis. And what we do and what we've been trying to do is always to give you pre-fact analysis. What will happen, what could happen. I really don't think that you traders should be interested what happened, because you can see what happened, right? You can usually read what happened. I mean, it's easiest for me to place pivot point indicator here and say, okay guys, these are pivot point levels, watch for pivot points, this is support, this is resistance. That's like 70% of the analytics is across the internet. They print out some fancy indicator and say, okay, this is resistance, this is support, price went here after, well, who cares where price went after it made movement? Traders want to see how to make pips, where to place entries and earn money, earn pips. That is the role of the analyst, for me, in my opinion, to provide you with pre-fact analysis that will tell you where to enter, where to find potential trades. This might see and might look like a trader chart, and I always provide you with this kind of chart on technical analysis page where we post our analytics. Okay, you can always see it here on the analytics page. Today, for example, euro dollar bullish. This is my part, and Chris also did the same with his wave analysis. So this is it. Euro dollar bullish order block marks the support. And if you read through all the article, okay, it's clearly explained. POC zone, where was POC zone? POC zone was around 101 points, so around 0.10, 40 to 50. Price went here very, very, very close to POC, very close, and then spiked to the upside. So I wanted to tell you guys, when price drops, buy here. So this was the point of this analysis. And this was clear POC zone. You see, trend line, 3 trend line touch, according to Denmark, he likes 3 touch trend line. I prefer also 2 touch trend line, but it doesn't matter. This was clearly POC zone. Guys, this was bullish order block here. You see, spin bar, this was bearish candle, but the height of this bearish candle was actually bullish order block. And this actually, I mean, this was very clear, a lot of confluence here. And then what happened is price simply rejected from this level to the upside. So that was the point of this analysis, to give you pre-fact levels where you can actually trade the price. Simple here on this chart. I mean, I don't need any stochastics here. This is price action. So longs around these levels. If I miss the long, okay, I will go back to my scalping template, and then I will try to execute long scalps. Scalps that are in the direction of long trades. Why not, guys? If I miss positional entry, I know that the trend is to the upside. I saw that price was very, very close to POC. Maybe you can enter a couple of pips, I always say above POC, if you see that the price will reject, or if you miss it, just scalp in trend direction. It's always the safest bet. We cannot pick the tops. Look, for example, pound dollar today. Pound dollar spiked higher, not because of technical analysis, but because of sudden news that UK court didn't approve Brexit vote. So, I mean, guys, this was very bullish for pound dollar. And look what happened. Now this is supported trend line. I might do pound dollar analysis tomorrow, but it's important to mark that tomorrow is NFP, so man, a lot of things can happen. Watch this. Today ATR 197 compared to previous 7 days ATR 118. So it was 80 pips above average ATR for last 7 days. What does it tell you? It tells you that there was some news that spiked the price. I mean, why would this happen without any obvious reasons? Okay? So you see, you need to know all these things in order to analyze the price, in order to predict price movement. Paul Evans is asking me, what is POC? POC is simply translated to trading terms, the zone where you can place your buy or sell trades, according to my analysis. POC zone is a zone where we expect the price to bounce. You will always see POC zone on my charts. And it's clear, you place buy or sell at or very close to this zone. You see, it's always about POC zones. This is where we place our trades. And probability about having a successful trade is high, simply because these charts use price action confluence. Okay? POC always will appear on these charts. So that's important to distinguish. That is why the advantage of all of you who follow Chris and me is because we are not just analysts, guys. We are also traders. And it's simply, we try to provide you with the most current information we have on markets. Also, on our educational webinars, we tell you about the risk you should use. A typical analyst simply cannot tell you about the risk because he doesn't know anything about risk. he didn't experience losses. That is why he cannot tell you about the risk. Every serious trader needs to accept losses. And every serious trader couldn't have been a good trader if he hadn't had experience a loss. And that is why we educate you, because that is our, and that has been our life. Both up and down, both ups and downs. We learned from our own mistakes, and there was no one to teach us. So we needed to go through all these by ourselves. And that is your advantage too. We care about your trades, and we will always give you a sincere trading advice about which pairs to trade. If you ask us about risk, we will always be honest with you. If you are gamblers, again, we will be honest with you. It's not just about analysis. The best is when you combine both of those two worlds. Doing an analysis and then trading that setups. So guys, that is what I was also trying to explain. I hope that everything is clear now. And simply said, shorter term analysis is much different and, in my opinion, harder than long-term analysis, because long-term analysis might be forgotten, but short-term analysis, traders prefer to trade intraday and intra-week, swing trade, or intraday trades. Long-term analysis is, you see, there are a lot of banks there which give you their own long-term predictions, and usually none of those are hit. Usually because a lot of things can change during the course of a single year, during the course of 6-7 months. There can be a lot of fundamental risks and events that can change the overall picture of a currency pair. Two main currencies. The single king of the currency is dollar, and just below the dollar is yen. Yen is risk currency, guys. Risk on, risk off. All other currencies, including euro, Australian dollar, right, they're different. But pay attention to dollar and yen, and cross pairs of dollar and yen. No matter what the outlook may be, those two currencies rule. Pound now, okay, pound is good to trade, as I say, simply because of Brexit, all those things that happened with Brexit. But don't forget, UK is a service economy. Their sector is finance, guys. Services is different. New Zealand and Australian dollar are commodity currencies. New Zealand is soft commodity, Australian dollar is hard commodity currency. New Zealand dollar is linked to dairy and milk products, while Australian dollar is linked to iron ore, copper, gold. Is the difference. CAD is linked to oil. But simply said, dollar and yen are kings. First dollar, then yen. And prepare always to watch how equities move if you trade yen pairs, especially during Asia session, Nikkei, let's say. Dollar, yen, and Nikkei, the strongest correlated pairs out of all pairs in Forex market to equities. And now that is what many traders simply don't know of, and I'm sure that also many analysts can never heard of. Okay guys, this was everything. I hope that you enjoyed the webinar. Tomorrow we expect NFP analysis and the coverage, of course, on US elections, how to trade it on Monday. Thanks for listening, guys. Thank you, Paul, for your comment. Paul is saying, excellent webinar. Thanks, everyone, for your comments. Don't never forget that we are here to help you guys. So take care and talk to you very, very soon. Cheers, guys. Trade safe.